And welcome back, options traders. And once again, I have to apologize for the recent disappearance, but I've been super busy with a lot of projects and just unfortunately haven't had the time to produce the videos as much as I'd like to. But hopefully we're back on track. And today I wanted to tackle one of my favorite questions: should you roll out early? So what we're talking about here is you've got this option, maybe you've got 30 days to expiration or a couple of weeks, and traders start going, oh, you know what, I'm starting to go off that steep part of the time decay curve. Let me roll it out prior to expiration. That's what it means to roll out early. Well, is that a good idea? Well, as always, let's go find out. And before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is greatly appreciated. So let's start with a time decay graph. Now remember, this is for at the money options only, or let's call it near the money. Something that's maybe slightly in or slightly out will reasonably have this shape of a time decay graph. And so we're looking at 720 days until expiration. All the way down here is 0. That's expiration. And here's the value of the option. So this 2-year option's worth about 16 bucks. And as time starts to go away, we start to slide down this risk graph. And you can see that it's fairly flat in this region, at least compared down to here. So just imagine that if you're going down a ski slope, you're not going super fast through here like you would be down here. This is when the option really starts to go off that time decay curve and starts to lose value. So this becomes the dilemma. Traders are watching time tick by and they say, oh gee, when I get into this area, let's say with 30 days to expiration, I'm going to really start going off this time decay graph. So maybe I should roll it out, extend it to 3 months or 6 months, whatever. We just don't want to be inside of this 30-day mark. Well, there's another problem too when traders look at this risk graph. Let's say if they put this option on with 2 years till expiration, now it looks like maybe 60 days, maybe 90 days look like the danger zone. And so back here, when they put the trade on, they say, you know what? When this option gets to be within 60 or 90 days, I'm going to roll it out. I'm not going to let it go all the way to expiration. Well, again, the question is that a good idea? Well, like most questions and options, the answer is it depends. And what I want to talk about for this video is just 2 specific cases where in one case it's not going to be such a hot idea, and in the other case you could certainly make an argument that it could be beneficial. So let's start off with the types of rolls. In the options market, we have a couple of ways we can roll an option. You can roll them in and out, and that refers to time. You can also roll them up and down, which refers to strikes. So for example, let's take a look at a quote board or a options chain that you will see on a typical broker's platform. And there you're going to see expiration months across the horizontal and your strikes along the vertical. So if you roll in this direction, you are rolling out. What that means is that you are staying in a given row or a given strike price, but just extending the time. So let's say that you have the January 90 call and you close it and roll it out to the March 90. Do you see how you're staying in the same row, same strike, you're just going out in time? That's a rollout. You could also come in this direction where you're doing the opposite. Maybe you've got the March 90 call and want to swap it out for the January 90 call. That would be rolling in. And there are some good strategic reasons why you might want to do that. Now, what's a roll up? A roll up is when we go in this direction. We are rolling to higher strikes. So let's say that you have the January 100 call and you roll up to the January 110. That's rolling up. And that would be true whether you're talking about calls or puts. As long as you are increasing that strike, it is a roll up. A roll down, just the opposite. You're going in this direction. So maybe you've got the January 100 call and you roll it down to the 90 call. Or maybe the January 100 put, rolling it down to the January 90 put. Those are roll downs. And of course, we can mix them. Maybe you've got the January 100 call right here and you want to roll to the March 110. you're going in this direction. That's rolling up and out. So there's a lot of different reasons why we might choose one of these rolls. Very good strategic reasons. But for this video, again, we're just talking about rolling out early. So I said that there were a couple of conditions where one, it's not going to be such a hot idea, and the other that it will. Or at least you could make an argument for it. And that is whether your option is in the money or out of the money. Now for this video, I'm just going to be using call options, but you would come to exactly the same conclusions with the puts. So let's start with rolling out an in the money option first. Remember that in the money options have high deltas. And in this case, with a call option, you should prefer to roll the call up. And that's because you could still maintain those high deltas, might never even have to give them up, but you're sweeping cash off the table. It's a beautiful risk management technique. And so we can get cash out of the position, but never give up those deltas. But watch what happens if we roll this out early. So let's consider a couple of options. Let's say that we currently have the $100 call with 15 days until expiration, and the stock is up at 110. So this $100 call is 10 points in the money. And we're considering rolling it out to the $100 call that has 90 days until expiration. Now this is going to be a net debit. Remember, a rollout means we're sticking with the same strike, which you can see here. We've got the $100 call. We're going to maintain the same strike. We're just extending the time. Longer dated options cost more money, so yes, it's going to be a net debit. And the question is, what do the risk graphs look like? Well, here's our $100 call with 15 days until expiration. Now you can see it's starting to look like our usual hockey stick graph shape that we get, but it still has some curvature to it. We haven't quite gotten to where we have that nice hard elbow on it, that little angle. But we're moving towards it, and that's because we still have 15 days until expiration. We can also see that our maximum loss looks like about 10 bucks, probably a little bit more. And that's because, remember, the stock is at 110. We have the 100 call. So it's currently trading for at least $10 of intrinsic value, and there'll be a little bit of extrinsic value. So that's why if we continue to hold this option and it goes out worthless, we're going to lose about 10 bucks. That's why this blue line is pointing right here to minus 10. So that's the risk graph that we're currently on, 15 days until expiration. What happens if we switch it out to the 100 call with 90 days until expiration? In other words, we roll it out. Well, we switch from the blue curve to the red. And there's a couple of things that should really stand out to you here. First of all, look to the far left. If the stock comes unraveled and falls all the way down here, we could lose more. And that's because the red line sits below the blue. Why? Because it was a net debit. We had to put more money into the trade. And so now we've exposed ourselves to potentially more losses. Well, are there any benefits? Well, let's look out here to the gains. If the stock does continue higher, which presumably is our expectation, which is why we want to extend the time, now we can make less. The red line again sits below the blue. Why? Because we had to pay more money for it. We have lower deltas, and we can see that right here. The stock is at 110. So if we stay on the blue line, you see how it starts to accelerate faster than the red? It's a little bit steeper through here than the red. So by switching from the 15 days until expiration to 90 days, we've also reduced our deltas. Now, are there any benefits at all? Well, not many, but you could make a very small argument down here, where the red line sits above the blue, that little green sliver in there. You could say, if the stock falls, I'm going to lose less because I have lower deltas. Well, that's true, but you could also reduce your deltas by rolling the call up and getting cash off the table rather than putting more money into it and potentially losing more. So that's why I say it's really just not a good argument, but that would be about the only benefit. But the things that really stand out, because you've bought time, you've received lower deltas, larger potential loss, and a lower potential reward. So not much of a benefit at all for rolling out the option early. Now also, if we really want to focus on this slight benefit to the downside, remember the reason that this red line sits above the blue right now is because there's more extrinsic value in the red. But you had to pay for that. And that's going to be slowly bleeding away. You've now exposed yourself to higher theta. So if it turns out over the next 90 days that the stock price doesn't move too much, you're going to move from the red down to this now hockey stick graph. And now it becomes very clear that had you stayed on the blue curve, you were better off than the red curve every step of the way. So there's really just very few arguments for trying to roll out an option early if it's in the money. All right, well, what about its counterpart? What if it's an out of the money option? Well, out of the money options have low deltas. And rolling out, yes, is going to increase the potential loss and lower your potential rewards, just like it did for an in the money option. But it also will increase your deltas. And if we're expecting the stock price to rise, well, maybe this isn't such a bad investment. So let's go through the same example here. We'll look at our $100 call with 15 days until expiration. But now let's say the stock has fallen to 90. Previously, we looked at the stock going up by 10 bucks to 110. Now we're going to say it's fallen 10 bucks down to 90. And what would happen if we roll out to the $100 call with 90 days until expiration now? What do the risk graphs look like? Well, now they look like this. And you're thinking, hey, they're virtually the same thing. And you're exactly right. It's just that now with the stock down here at 90, that option was virtually worthless. So if the stock does continue to fall, we don't really have that much to lose. Now remember, that doesn't mean that we didn't lose a lot. We might have paid $10 for this option. But we're talking about valuing it from right now, from its current price. And the additional cost to hold it is not much. But if we roll out to the 90-day option, we move to this one in red. And we now have, again, more to potentially lose. If the stock does run, we have less to gain. Again, the red curve sitting below the blue. But look at this little area of benefit that we saw before. Remember, the stock is down here at 90. And so if we stay on the blue graph, do you see how flat that is? There's no deltas there. But if we move to the red graph, now look at how that red line starts to accelerate much sharper and much faster than the blue. So hey, if we think the stock is going to move from 90 to 95 to 100, hey, go to the red line. Might as well put a few more dollars on the table and get these nice higher deltas through here. So yes, it is true that you bought time, you had to pay money for it, but you also bought higher deltas. So you can see the difference here. When the stock is at 90, by rolling out early, you are moving into this beneficial zone in green. You're moving from left to right. That's our expectation of the stock. But notice on the previous roll, when the stock was up here at 110, we were moving away from that beneficial zone. We expected the stock to move, and all we were doing is moving into an area of smaller gains. We only got this potential benefit as a hedge if the stock went against us, but once again, we could get that exact hedge by rolling the call up and getting money off the table. So the thing to understand about rolling out early, if you have an in-the-money option, there's very little benefit in rolling out early. You're going to lower your deltas, you've got more money to potentially lose, and you've got less to gain. Now, yes, again, you could make this small argument that you've got fewer deltas and it gives you a little bit of a downside hedge. But remember, you can also reduce your deltas by rolling up and get cash out of the position. Now, if you have an out-of-the-money option, it can be a different story. For an out-of-the-money option, sure, there may be a benefit in rolling out early. Just like with the in-the-money options, you have more to lose and less to gain, but you also have higher deltas. You're moving into that area of the benefit, and that could certainly be an argument for putting more money into the trade. Of course, that means you have to be pretty confident that that stock is going to continue to rise. So I hope that helps you with your decisions about rolling out or rolling out early. And if nothing else, I hope it gives you a little more insight why options can be very tricky. There's almost always an exception, and I hope this helps to point out some of those exceptions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.